All right, good morning everybody in the UK. Good afternoon everyone in China. I hope you got the hour right. It's always a little scary holding these online events when the hour changes in the UK, so we've had a few people log on at the wrong time. Delighted to welcome you this morning to our webinar on posting UK staff to China, the tax and financial consideration for business and employees. Just before we begin, just a little bit of background on the CBBC. The China-Britain Business Council is a leading organisation helping UK companies grow and develop their business with China. CBBC supports companies of all sizes and at every stage of market entry with practical in-market assistance, services, industry initiatives, as well as a membership program offering access, seminars and significant networking. CBBC works closely with UKTI and the FCO and has a strategic partnership with the British Chamber of Commerce in Beijing, providing corporate members with reciprocal membership. Our business-led board and professional team have extensive first-hand experience of doing business in China, and throughout 60 years of engagement, CBBC has built up exceptional connections with government and business across China. CBBC services are delivered through a network of 10 offices in the UK and 13 strategic locations across China. CBBC helps companies to network and learn from China-savvy multinationals and SMEs to understand the intricacies of doing business in China and to develop sound strategies for expanding in the fast-changing and dynamic marketplace that is modern China. So that's just a little bit of background of ourselves here at CBBC. For our session this morning, this is quite an interactive session, so if you'd like to ask questions, you can do so. You can see that I'm highlighting this little area here. So if you have a question, please drop it into that. It'll appear on my screen and I'll be happy to ask one of the presenters as we go along. If it's not relevant to their speaking at the time, I'll just save it until the end. All right, if I could ask you please to click on the raise your hand button. If I could ask you please all to click on the raise your hand button. You can see I'm highlighting it here. That just allows me to know that you can hear, basically. So if I could ask you, yeah, I can see some hands going up there. Great, let me just double check. Lots and lots of hands. Brilliant. All right. So if you've got any issue, that could be a question for the speaker or maybe a technical sound issue, or if anything is not right for you, please just drop it into that section that I'm highlighting. All right, moving swiftly along. Our two speakers today, Adrian Sham specializes in the international assignment market, assisting companies on how to create, structure and implement their assignment policies efficiently to assisting their expatriates with personal tax issues that have arisen as a result of their assignment. Adrian has worked with a broad range of clients ranging from wealthy individuals and families, small companies sending their first assignee abroad, to multinationals who have a large global assignee population at any given time. In the finance sector, Adrian is responsible for a number of bank investment firms' expatriate populations. His expertise includes knowledge of the UK-US expatriate tax and social security issues, modified payroll, along with the UK residence and domicile rules. So that's our first speaker, that's Adrian. Our second speaker today is Ruth. Ruth specializes in UK and US expatriate tax. She has extensive experience of dealing with international assignments, advising both individual expatriates with their personal tax issues and employers involved in international secondments. Ruth has worked with a broad range of clients ranging from wealthy individuals and families, small companies sending their first, this sounds very familiar like the last one, abroad to multinationals who have large global assignee populations at any given time. Ruth is able to advise on US and UK tax planning and compliance, as well as payroll and social security issues surrounding international assignees. All right, terrific. So there are two speakers today. What I will do now is I will just hand over to Adrian. I'll just check that you're online. Adrian, are you there?
Hi, it's Adrian and Ruth.
Hi.
Brilliant. Well, before we begin, as I say, this is quite an interactive platform, so we do have online polls. Our first poll that I'd like to ask everybody is quite simply, where are you? So this poll should pop up now. If you could just click where you are, I'd be curious for ourselves to know and just get a better understanding. I can see that almost 80% of you have voted now, which is very good. All right, I think it makes the point. So we'll close that, and just to share the results, and we'll have a number of these polls throughout the session. So 61% UK outside of London. That makes us quite happy here in CBBC. One of the reasons that we do this is to be able to give people who wouldn't ordinarily travel to an event like this the opportunity to participate and get expert content from our two speakers today. All right, I'm going to hide that, and I'm going to hand over to Adrian and Ruth. Adrian, over to you.
Thanks. Ruth's going to start the presentation, so I'll hand over to Ruth.
Okay, hi everyone. Right, so as our slide says, this is looking into posting of UK staff to China, so looking at the tax and financial considerations for businesses and employees. Specifically, the questions that we're hoping to answer for you are identifying tax planning opportunities for your assignees, looking at how to manage double tax liabilities for your short-term assignees, looking at your employer obligations in China, employee considerations and concerns, and also structuring for your incentive plans. If we could have the next slide, please. So we have split this into 4 different areas which we typically see: short-term business travellers, longer-term assignments, that's anything from 6 months to 5 years, repatriation, and then lastly looking at issues to consider when you're planning your overseas assignments. Next slide.
I think we have a poll at this point, do we? Your first poll? Great. So let's jump in with this. This is, I suppose, to allow our speakers today just a little bit of a better understanding of exactly who's online. So the question there, how would you describe your current UK to China mobile population? So you have a number of answers there. Short-term business travellers, assignees on secondment lasting up 5 years, secondments transfers lasting more than that, and no employees working in China yet. So as I say, this just gives an understanding for our speakers today as to the demographic of who is online with us. So just give it another couple of seconds. Okay, I think that's pretty much everybody. 85% of you anyway. Let's close that and I can share the results. And Adrian, so you can see 30% short-term, 50% assignees on secondments number 2, 5% secondments local transfers, and the final one, 15% local employees. No local employees working in China yet. So there's a bit of a mixture there today. I hope that's useful for you, Adrian and Ruth.
Yeah, I think that's pretty similar to our part base as well, so it's interesting to see.
Okay, back across.
Okay, moving on to the next slide. So the specific issues that we're going to look at for the short-term business travellers are identifying when the travellers actually trigger Chinese reporting, filing and withholding obligations, both for themselves and for the company. We'll also look at treaty relief when it's available, and also the UK tax implications for the employee and the UK company. Next slide. So when does a business traveller trigger Chinese reporting obligations? Under Chinese domestic law, if the traveller is in China for less than 90 days, there shouldn't be any Chinese tax due if compensation costs are not borne by the Chinese entity and there's no permanent establishment in China. That is something that we'll touch upon later on in the presentation. So providing it is less than 90 days, there shouldn't be any Chinese withholding or reporting obligations for the UK company or the employee. If the traveller is going to spend more than 90 days in China during the calendar year, there may be Chinese reporting and withholding obligations for the employer unless the treaty exemption can be implied. It's worth noting at this point as well that we will assume the immigration and work visa issues should all have been sorted before you consider sending your business traveller to China.
So if we move on to the next slide, if we've established that an individual has gone over to China for more than 90 days, there are still other ways to hopefully mitigate the Chinese tax obligations. Obviously this won't work in all cases, but if you can, the more you can get out of Chinese tax, then the easier it will be for you to run your business and your operations. So there's an agreement, a double taxation agreement between UK and China, and within that agreement, it basically tries to avoid an individual paying tax in both locations or paying double tax. They may still pay tax in 2 locations, but there should be appropriate credits available, so they will typically pay the higher of the 2 countries' tax rates. If you've got a UK individual going over to China, then the 3 conditions, if they meet, are listed on the slide, which I'll go through shortly, and if they meet these following conditions, then the treaty exemption applies, and therefore they'll remain subject to UK tax and are exempt from Chinese tax.
Adrian, quick question
So
here.
one,
Just want to jump across you if I could. It's a question from Nikki. Is that 90 days at a stretch or lots of short visits?
It's lots of short visits, and basically any part of the day in China is generally treated as a Chinese day, and there'll be further discussions around that later on in the presentation.
Lovely, thank you.
So the first test, as I said, was this 183 days. So as long as your individual spends, or their total days does not exceed 183 days in a 12-month period, just be careful that 12-month period is a rolling period. So it's not just the calendar year, which is the fiscal year, but it can overlap into other calendar years as well. The second point is to do with the costs of the employee. None of it is paid by the Chinese entity or a Chinese entity, or none of it's borne by a Chinese entity. We'll go into that in a little bit more detail in the next couple of slides. And then the third one is there is no permanent establishment or fixed base in China for the UK employer, and the costs aren't borne by that permanent establishment or fixed base. So if we move on to the next slide, based on those conditions, there are a number of key considerations. Where you've got an individual working for a UK employer and has been sent to China, the first thing is you should make sure that that individual does not create a permanent establishment of the UK company. This could be, for instance, where you've got no Chinese entity, or even when you do have a Chinese entity, but the individual continues to work on behalf of the UK entity. And it's careful. We're not going to go into permanent establishment in great detail. All I would say it is a moving piece, and the Chinese authorities may take slightly different approaches to permanent establishment to other countries. And the reason why it's important is that usually when a permanent establishment is triggered, it's both a corporate tax risk, so you might bring some of the UK profits into Chinese tax for the company, but also it means that the individual is unlikely to be able to get this treaty relief that we're mentioning here. The second point there relates to recharging costs. So where you've got an individual in the UK being seconded to a Chinese entity, if there are any costs borne by that Chinese entity, either through transfer pricing recharges or simply the Chinese entity pays the salary, then that will also take them out of the treaty, and therefore they'll be taxable in China. And the third point I just want to make is to make use of the UK-Chinese treaty, the individual has to be resident in the UK and subject to tax in the UK. And for those of you who aren't aware, the UK rules around residence changed as of 6th of April 2013. So if you've got individuals moving abroad, we just need to bear in mind that these new rules are in place. And unfortunately, they're slightly more complicated than the old rules. Moving on to the next slide.
Question from Henk, if I could.
Yeah.
Henk asks, when you have a PE in China, 183 days, is this the cut-off point for possible tax and NI liability?
No, so if you have a PE in China and that individual's costs are borne by that permanent establishment, then simply you aren't able to claim the treaty. The three previous conditions, the 183 days, the permanent establishment point, and the cost borne by a Chinese entity, you have to meet all three to claim the treaty. Sorry, I probably wasn't very clear on that. So if you fail any of those tests, either the individual spends more than 183 days, or their costs are borne by an employer in China, or their costs are borne by a permanent establishment in China, then that individual fails the treaty and is subject to Chinese tax.
Okay, thank you.
So if we go to the next one, just a few other points to note that will take you out of the treaty. So David, sorry, next slide. So there are certain individuals who, even though they meet the 183-day test and the others test, they'll still be subject to tax in China. So if they're senior management personnel, representatives of the representative officers, then they may still be subject to Chinese tax. There are also more complicated situations where the treaty applies when individuals have two sources of incomes. So where they may have duties in the Chinese entity and also duties on an overseas entity. And obviously for these sorts of individuals, we recommend that you seek further advice in terms of planning. Are there any ways that you can minimize the Chinese tax further, and so forth there. One thing that you'll see throughout the slides today is that the Chinese practice and interpretation of rules and how each of the tax bureaus operate across China are different. So where you've got an individual, say, going to Shanghai and where you've got another individual going to Beijing, although they might have exactly the same fact patterns, you might have to undertake different registration requirements, different exemption requirements. So just be wary that just because you've got two individuals going to China, China's a slightly bigger place than the UK, I guess. They may be subject to different rules in each, or different interpretations in each case, and different practices in each local area.
Okay, next slide, please. Okay, so this is just looking at the UK side of the short-term business travellers. So the tax and reporting implications for the UK company. As Adrian has already touched upon, for the treaty exemption to apply, and even if it doesn't, the short-term business traveller is likely to remain resident in the UK. They won't meet any of the overseas automatic residence tests. Assuming this is the case and the business traveller has remained resident in the UK, that individual remains taxable in the UK on his worldwide income and gains, so that includes his employment income. Furthermore, for the company will continue to have a UK PAYE withholding obligation. Typically what we would see is if an assignee or a business traveller is only going abroad for short periods of time, so a couple of weeks here, a couple of weeks there, they would remain on the UK payroll. So typically this means that there's not any action required for the UK company with regards to the payroll. PAYE and UK national insurance should just continue to be operated as normal. We do try to flag up with clients, however, that one thing to be aware of is reporting of business expenses incurred during the travel, or any benefits provided overseas. So if benefits were provided to the traveller in China, it might be worth checking to see whether they need to be reported in the UK. As we've mentioned, the employee remains taxable on all of their employment earnings and benefits, so this would need to be picked up either on a P11D, or if it's covered already by the PSA or dispensation, that's worth checking. There are also tax reliefs available for the business travellers in the UK, so if accommodation is provided in China, it's not necessarily going to be taxable, but it might still be reportable in the UK.
Yeah, and it's just worth noting on that point. So a lot of our clients that we speak to, where they may have appropriate dispensations in place, and basically what that does is, if something isn't taxable, dispensation means you don't have to report it to the UK authorities. Even though they have those in place, a lot of times, if you haven't sent someone abroad before, or the dispensation is quite old, then it may not actually cover your assignees going abroad to China. So it's just worth double checking that, making sure you've got the appropriate dispensations in place with HMRC.
Okay, next slide, and I think we might have a question there.
Yeah, I've got a quick question here, and I'm not going to pretend I understand it because there's some acronyms here, but I'm going to read it out and hope you do. Is a certificate of coverage required for STBVs to keep them in UK NIC?
Well, point number one, yes. So a certificate of coverage is required in some situations to keep an assignee within UK social security. For an STBV it may be required, however with China there's not actually a social security agreement in place. So a certificate of coverage can't be applied for in this instance regardless of the length of their assignment situation. We will, I think, again cover national insurance later on, but essentially a UK assignee going to work in China remains liable for the first 52 weeks of the assignment period. They're liable to UK social security, after which they fall outside of the social security in the UK. You don't need any sort of certificate of coverage or A1, which you would require if they were going to the EU.
Yeah, so we mentioned earlier there's a tax treaty between UK and China. Unfortunately, there's no current social security agreement between the UK and China, and therefore, as Ruth said, certificate coverages aren't applicable in this instance. But if you've got other people going to China, then that might be applicable if there is an appropriate social security agreement between that other country and China.
Okay, thank you for that.
Okay. Okay. Right, so the next section we're going to look at is longer term assignments. So this is 6 months and longer. Next slide.
I think we have a poll here. I'm going to launch that. I think it's how comfortable are you, I'll just launch it for everybody now.
Oh yes, I believe we do, yeah.
How comfortable are you that your company is meeting its UK and Chinese reporting and withholding obligations with respect to your mobile employees? Are you very confident, fairly confident, not at all confident, or don't know? So we'll just leave that run for a second. I think we can, there's some pretty clear answers coming through this. I'll just give it another second or so. I'll close that. And so very confident, 14%. Fairly confident, 53%. Not at all confident, there's a few of you out there at 8%. And 25% of you probably not good, don't know. So interesting for yourselves and Ruth and Adrian, just to get a bit of perspective on who is out there and where they stand.
Thanks for that.
Okay, so the topics that we're going to consider for the longer term assignments, this is 6 months or longer, the Chinese withholding reporting requirements for the company, identifying efficient tax planning opportunities, again looking at the UK tax implications and the managing of any possible double withholding obligations, and we'll also look at the tax implications for the assignees who are remaining in China for more than 5 consecutive years. All right, so if we could have the next slide, please. So as we've already discussed, if they're over 90 days or they don't meet the conditions of the Double Tax Treaty, the individual is going to be taxed in China on their Chinese-sourced employment income. So the Chinese entity where the assignee is working will act as a withholding agent, and they will have a monthly filing requirement in respect of the tax due to be withheld. It is worth noting that the withholding obligation will kick in retrospectively from the first day once they have exceeded their 90 days of presence in China. The payments have to be made over by the company within 15 days after the end of each month or before that, and there are penalties for late payments. So if we just move on to the next slide. Interest may be charged at 0.05%, it says there per day, and that's from the date that the withholding tax is due, and also the tax authorities can impose a penalty from 50% up to 500% of the amount of tax unpaid or overpaid, so that's worth noting, so it can be a financial issue for you. Right, moving on to the next slide. Right, so now we're just looking at the employees' Chinese tax, income tax reporting. So obviously not something for the company to be concerned about, but it is something that the assignee will want to know about before going, and it might be for the company to provide assistance for this. So the individual may have an annual filing requirement in China if his annual gross remuneration exceeds 120,000 renminbi, and if he becomes a full-time Chinese tax resident in that calendar year. As we have noted on the slide, the foreign individual will not be considered as a full-year Chinese tax resident if he's outside of China for 30 days consecutively or more than 90 days during the calendar year. Again, we have touched upon this already, but just to reconfirm that in counting days, the arrival day in China and the departure day in China are both counted as days of physical presence in China. Days spent in Hong Kong, Taiwan and Macau aren't counted. So it's worth the individual tracking their days to determine whether there will be a Chinese income tax reporting obligation for the individual. Okay, next slide please.
Ruth, I have a question here. I'll forward the slide, but it's a question from Hugh. He says, can withholding tax be reported or paid by the WOFI and recovered from the UK parent? If not, how do we report or pay from the UK?
So I didn't quite catch the last part.
So can withholding tax be reported or paid by the woofie and recovered from the UK parent? And if not, if that can't happen, how would you report or pay from the UK?
So just for those individuals who don't know what a woofie is, it's effectively it's a Chinese subsidiary of an overseas owned company. And the answer to that is yes, the Chinese woofie should be able to recover those taxes from the UK employer or the UK payroll side of things. So that should all be okay. And if Hugh needs help with that, we can follow up with him afterwards.
All right, lovely, thank you.
Okay, so just moving on to Chinese Social Security. So this is on the Chinese side. Previously, Chinese Social Security contributions weren't required by foreign nationals. The China Social Insurance Law did come into force in 2011, and that sets out that foreign nationals working in China should participate in the Social Security contribution system, particularly those who are legally employed in China, i.e. they have their work visa. However, as Adrian has already commented on, and which we will mention again, the local practice, the level of contributions and the level of participation does vary from location to location. So, for example, it's not required in, it's not yet mandatory in Shanghai, but it will be in other areas. So that's something that you would need to seek further advice on from specific tax bureaus to determine whether Social Security is due. Linking that back obviously to the UK, as we've said, there isn't an agreement in place, so it's not a case of because you're paying UK Social Security contributions, you're therefore not obliged to pay Chinese Social Security. The two don't marry up, so the 52-week rule will apply in the UK regardless of whether you do fall within the Chinese Social Security regime. Okay, next slide please.
So what we want to do now is, obviously we've gone through some rules in terms of what your obligations are in China and how you can potentially mitigate some of those. Obviously, if you've got individuals in China and they're subject to Chinese tax, you want to try to minimize as much as possible. So sorry, next slide, yeah. And this is, I guess, if your employees actually paying their own taxes whilst they're in China, this is goodwill, you know. You're helping them structure their assignment benefits so they're tax efficient. If, on the other hand, you've got some sort of tax equalization policy in place or tax protection policy in place, or you just simply pay some of the Chinese taxes on some of the benefits, that if you can minimize the tax on these benefits, then that will reduce your Chinese tax burden whilst the assignees are over there. So there are 5 ideas that we want to go through over the next 5 to 7 slides, I think. So if we go on to the next slide, we'll go to the first one, which is to do with time apportionment planning. So the default position is that an individual who's sent over to China is required to report their full employment income for the Chinese income tax calculation. But where they have duties both in China and outside of China, for instance, they're only a business visitor going there for a few days here and there, or they're actually on assignment but they've got a split role across Asia, so they spend 30 or 50% in China and the rest traveling around, then it is possible to exclude the Chinese tax that relates to their non-Chinese duties. So in an example, if they spend 70% of their time in China and 30% in Singapore and other countries, then although you use 100% of the earnings to calculate the tax, roughly 30% of that tax will be reportable to those non-Chinese duties and potentially excluded. How that is done on a monthly basis, and usually the fiscal days of presence are used when you do the calculation. There generally isn't a requirement to register or certify this in advance to tax authorities, but when the claims are made, then the tax authorities may require further information. For example, they may require the underlying overseas contracts, copies of assignment letters to show that they have both duties in China and outside of China. So there's a piece here where employees who have employees who could take advantage of this need to make sure that they've got the right paperwork in place and also the right structuring in place. especially as you note that at the bottom, that time apportionment method is generally not applicable when you've got payroll costs borne by the Chinese entity. So where you've got an individual who only works part of the time in China, you may want to look at only bearing some of the costs in China rather than all of the costs.
Okay, next slide, please. So we're next looking at tax-exempt benefits provided by the company. Obviously, typically, most assignees will get some sort of level of benefit provided by the company, or if not, at least an allowance. So as we set out here, some of the benefits that can be tax-exempt in China if the assignment is structured correctly. So housing expenses, tuition fees for the assignee's children, home leave expenses, this is limited to travel costs, meals and laundry, relocation and moving expenses, and language training expenses. So those are the items which can be exempt in China. If we move on to the next slide, it sets out the conditions that have to be met for the tax exemption to be applied. So the employee has to be a foreign passport holder, which should be the case if they're a UK outbound. The expenses need to be paid to the vendor directly by the employer or paid to the employee on a reimbursement basis. So it can't be a case of just giving a general allowance. All expenses must be supported by appropriate documents, so the assignee or the employee have to keep track of all the receipts. And as we understand from our colleagues in China, that the level of receipts is quite onerous, so that you do have to keep all the documentation relating to these expenses. And lastly, the accounting, the assignment contract essentially that's in place has to be consistent to reflect these expenses. So it has to be proven that the company is always going to provide these expenses, and typically that happens by, as you said, putting it in the assignment contract, setting out what provisions will be provided by the company.
So the third one is on the next slide is it's to do with bonus payments. So if we move on to the next slide. If no planning is taken, then generally all bonus payments are, or the default position is bonus payments are treated like normal salary, subject to normal payroll taxes on a monthly basis, ranging from 3% to 45%. If you've got bonuses which are paid, which relate pre-post assignment, so relate to non-residence period, then it's possible to source that bonus and only tax the Chinese element of that bonus. And if we do a bit of planning, as shown on this next slide, then we might be able to reduce the tax on the actual bonus payments. So on the next slide, David, the planning really comes around because there is a preferential tax treatment or tax calculation for bonuses, but you're only allowed to utilize this once a year. So where we have clients who have quarterly bonuses or commission-based bonuses which are monthly, then if it is possible to restructure those as one-off annual bonuses, you can take advantage of this favourable tax rate for the whole bonus rather than just one of 12 or one of 4 bonuses that you pay during the year. And from the clients that we've seen, we've usually been able to save between 5 and 15, 20% tax on that bonus amount. So it's certainly worth considering, obviously, the higher the bonus payments are. It's worth noting that, again, as you've seen in another number of other slides, if the bonus is paid or borne by the Chinese entity, there is still an obligation to withhold on the full amount. So from a cash flow perspective, that's not ideal, so you might want to think about only charging a portion of it to the Chinese entity. On the flip side, we just need to bear in mind with our UK hats on, if the bonus relates to UK periods, or even in some cases where it doesn't relate to UK periods, you just need to make sure that you operate the correct level of UK tax withholding as well. So if the bonus relates to the UK employment before assignment, then UK taxes should be withheld on that portion of the bonus.
Okay, moving on to the next slide. So this is similar to the bonus structuring. It's just thinking ahead to make sure that any pre-assignment or post-assignment earnings are paid correctly to ensure less admin and to determine whether any withholding will be due. So Chinese tax will need to be operated on any payments made during the assignment period, so when the assignee is there working, subject to the time apportionment planning. So it's a case of thinking ahead, and if there are any non-Chinese assignment related income, is considering whether it can be paid pre-assignment or after the assignee has returned to the UK and is back on the UK payroll. Obviously, even if the payment is in respect of pre-assignment earnings, if it's paid while the assignee is in China and being paid through the Chinese payroll, withholding will need to be operated in China. The company should also ensure that no cost is recharged to China, as is may trigger a tax charge.
I think, David, we've got another question to ask.
Yes, now I think we're moving on to, is it equity-related issues? So we've got a question about that for everybody. I'll launch that. Do you have equity plans in place for your employees? Do you have equity plans? Yes, and overseas tax planning has been considered. Yes, but no overseas tax planning, and no. So we'll just let that run for a second. I've got a question here while we're letting that run.
Sure.
This is a question from Emily. It actually reverts back to something previously, but we'll just put it in here. In practice, how often are the fines or interest for non-payment of tax via withholding in China imposed? So, yeah, what's the actual reality of being late? Do you pay a fine or the interest?
From what we've seen, we've rarely seen them being applied. However, with my, I guess, tax risk hat on, we can never say never. And as with any tax authorities, if they think that there is money to be made is probably the wrong phrase, but if they think that there's a significant shortfall and penalties can encourage companies to be more compliant, then I suspect that they will pursue this more and more going forwards. So at the moment, typically we haven't seen penalties being applied. Obviously, it's better to come forward yourselves rather than be caught by the authorities, because that's going to be more likely to trigger penalties. But reality is we haven't seen that many at the moment.
Okay, thanks for that. And we have the feedback here from the equity plans. A pretty clear answer there. 2/3 of people say no. So there may well be something interesting for you to expand on now.
Okay, that's fine. So we've got a couple of slides on equity planning. So those individuals said no, you can switch off now, which would be nice. For the rest of you, just to give you a high-level overview. So if there's no planning in place, then obviously any exercise of stock options or restricted stock or stock appreciation rights or any other equity planning that you've got in place will be taxed like normal salary on a monthly basis at marginal tax rates as usual. The Chinese authorities have issued a number of circulars, tax circulars, and each of them addresses different particular situations. And if you fall within those particular situations, you can benefit from preferential tax treatment. So if you haven't got any equity plans at the moment, or you haven't taken advice on equity plans that you have got, it may be worthwhile just identifying or reviewing them to see whether you can either fit them into a tax circular or amend them slightly to fit them into tax circulars to benefit from this preferential tax treatment. As part of that, there's a number of things you'll need to do. One of those is that you'll probably need to register that plan with the local tax bureau, and this may or is probably going to include a translation into Chinese as well. And if you meet the conditions, then certain elements of income relating to non-Chinese workdays could potentially be exempt from Chinese tax. And again, if none of the costs are borne by a Chinese entity and the option or the stock is excised after the assignment is finished, so when they're back in the UK, then actually no withholding might actually be due. Just a word on that last point on the next slide, really, that even though there's no withholding tax, there still may be actual Chinese tax which the employee needs to report on their personal tax returns or their personal return. So David, on the next slide, sorry. It's probably also worth noting on the withholding piece and also the tax piece that Again, we just need to consider the UK tax implications of having these equity plans and having individuals working both in the UK and in China. There are a new set of rules coming out as of 6th of April 2015, so if that's exercised after that date, then there are different sets of rules in terms of whether UK tax should be operated in the whole amount or a portion of the option exercise. So if you haven't come across those, it's worth picking up with an advisor to make sure that you're compliant on those going forward. The other aspect on this slide, which we're going to pick up in more detail later on, is, as you may be aware, there are currency controls in place in China. So where you've got options being exercised or even just regular salary or bonus, and that your employee wants to bring those outside of China, then you just need to make sure that they've got all their ducks in a row so that they can actually take the money outside of China.
Okay, next slide. So this briefly just looks at a foreign national who's remaining in China for more than 5 consecutive years. Typically, if it's an assignment, this might then have moved to a local hire, so you might not refer to them as assignees. So if an individual is resident in China for more than 5 consecutive tax years, it means that they will be taxed on their worldwide income from the 6th year and for each following year of full-year residence. It is possible, however, for that individual to break up the 5-year rule. So if they spend more than 30 days outside of China consecutively or 91 days cumulatively during the tax year in any of those 5 years, it breaks up the 5-year period and the clock starts again from their return to the UK, to China, from the date they then have another full year of residence. The only consideration really is to think about the fact that any planning opportunities that were put into place for the original assignment may no longer be valid. But as we said, typically what we tend to see is if an assignment has lasted more than 5 years, that individual tends to move on to a local contract, in which case the planning opportunities might disappear anyway.
Okay, so if we move on to the next slide, we've gone through obviously some tax planning opportunities that can be taken advantage of in China. What we want to look at now is what the UK tax implications are of an individual leaving the UK to go on assignment or work trips to China. This is split into 2 parts, depending on whether the individual remains UK tax resident, which is this slide, and I'll be going through those, or whether the individual actually breaks UK tax residence, which Ruth will be going over in the next slide. So in summary, if an individual remains UK tax resident, they'll be subject to full UK tax, and obviously they may still be subject to Chinese tax, and they'll be subject to full UK tax withholding in the UK. So if you maintain the individual on a UK payroll, obviously you'll be deducting UK pay-as-you-earn. You may also have Chinese tax to deduct, so I think Hugh had that question earlier. If tax is deducted in China, you need to facilitate that transfer of tax over there. As you may have realised, there might be an element of double withholding there, so both Chinese and UK tax being withheld. There are a couple of ways to mitigate that. One is some employers apply for what's known as a net of tax foreign tax credit scheme in the UK, and what that allows you to do is reduce the UK tax withholding by effectively the amount of Chinese taxes that have been withheld as well. So there's no double withholding there. Some of my clients don't find that very easy to do administratively, either because their payroll can't do it, or it's a lot of work to get the Chinese taxes every month and convert it. The other option there is the company may want to step in and loan the amounts that's due in China, and then when the refunds or when the foreign tax credit claim is claimed on the individual's tax return, that goes back to the employer. The second point on this slide is if you decide that the individual is going to be paid from the Chinese payroll, that doesn't necessarily mean that the individual is exempt from UK tax and tax withholding. If they're still legally employed by the UK company, then the UK company may still have to operate a shadow payroll to facilitate any tax withholdings. And again, there is likely to be national insurance, as Ruth mentioned. An individual going on assignment to China is still subject to national insurance for 52 weeks, which I think Ruth's going to go through as well. The last piece is, again, we mentioned expenses and benefits, and we keep reiterating this because this is one of the key points that our clients need assistance with. Just need to make sure that you're comfortable with what needs to be reported in the UK side as a result of all the benefits that are provided by the employer in China.
Okay, so next slide, please. So I'm just quickly going to run through the implications of the employee breaking UK tax residence. So if they do become non-resident, typically we see this under the statutory residence test because they're going to work overseas for a full-time employment for a complete tax year. There are obviously conditions around that, but that's the main one we typically see. And if split year rules apply under the statutory residence test, this would be from the date that they either leave the UK or start working in China. The implication of this, if they remain on the UK payroll, is that because they're not taxable in the UK, the company can apply to HMRC for a NT-PAYE code, so a no tax code. That basically removes the company's obligation to withhold UK tax. Obviously there may be a Chinese withholding requirement, but they can then continue to deduct that. If they move to a Chinese payroll, so therefore leave the UK payroll, there shouldn't be any action required. Obviously the UK payroll for that individual will be closed. There may be a leaver certificate required, but essentially no further action there. However, as we have already briefly touched upon, UK national insurance contributions, even if the individual has broken UK tax residence, they are likely to remain liable for UK tax for the first 52 weeks of their assignment. If they have remained on the UK payroll, obviously that makes things a bit simpler and you just continue to withhold UK NIC. If they have moved to the Chinese payroll, you have to look at potentially setting up a shadow payroll to continue to operate UK national insurance for the first 52 weeks, after which they fall outside UK social security. As we just made a point here as well, is we've obviously referred to the Chinese penalties for failing to withhold. There are obviously penalties in the UK on the UK company for failing to operate UK PAYE. And potentially, if you're based in the UK, that may cause more of an issue with you, HMRC. They do tend to like to find an excuse to come into the company, and the failure to withhold will be a very good excuse for them to come in. Voluntary disclosures are often required. For example, if you suddenly realise you haven't been withholding, you should have been. That's something that you can look into.
And just on a national insurance point, we've obviously said there's this 52-week ongoing liability. In some cases where the individual is leaving indefinitely or for a significantly long period of time, there may be scope to write to HMRC and request that 52-week obligation is waived effectively because they become not ordinarily residing in the UK, because obviously they're living indefinitely or for a long period of time.
Yeah, following on from that again, just to clarify, UK national insurance contributions don't follow tax rules, so they are different, which is why different rules can apply. Okay, next slide, please.
Ruth, the questions are coming in thick and fast on this topic.
We're getting close to that, that's why.
I'm struggling to keep up with them here, tapping away on my keyboard. I'll try and drop a few in now and a few in at the end. And if we don't get to them, guys, I will forward them to our speakers today who can follow up directly with you. One question from Andy, and it's to do with the issues that we're talking about right now. Will the NT code apply in the UK for post-departure bonuses?
Yes and no.
Brilliant. That's clear enough.
Right, next question. No, strictly speaking, and then once you've received an NT code, you should be able to apply that throughout for any payments after the NT code. However, strictly speaking, if you pay a post-departure bonus which relates to the UK duties, the UK company obviously knows that it's taxable in the UK and therefore has an obligation to operate the appropriate level of UK tax withholding on it.
All right, one more just in this from Steve. He says, what class of NI contributions are payable?
So for employees in the UK, you're usually operating Class 1 employees and employees NIC, and when they leave, that continues for the first 52 weeks. After that 52-week period, then no national insurance is due to be withheld. but the employee, the assignee themselves, they may be eligible to make voluntary contributions to keep up their state pension obligations if they feel that they're going to be entitled to state pension in the future. And that could be either under Class 2 or Class 3, depending on their situation.
Okay, and one final one here. I mean, this is just a clarification. I got it from two people. Just if you could repeat what you said about the need or use of the shadow payroll issue that you mentioned. I think that was you, Adrian.
Yeah. So, I mean, where an individual, where the employer has an obligation to withhold both in the UK and in China, because they're subject to pay-as-you-earn in the UK and subject to Chinese tax over there as well, then obviously you need to withhold in both countries. But you physically may only pay them in some cases from one country. So if I'm seconded to China and I remain paid from UK payroll, UK withholding is made here, so I get the net amount there. However, because in my case Grant Thornton will have an obligation to withhold in China, to facilitate that they'll set up a shadow payroll in China, just sort of like a dummy payroll, so that all the Chinese calculations of how much tax is due to be withheld are done through that payroll, and then that amount is paid over to the Chinese tax authorities. And then I guess the middle piece there is obviously you've withheld in China, but you actually need to physically withhold from or fund that somehow. And that's the piece where we mentioned the net of foreign tax credits or possibly the loan opportunity there, just to avoid the individual bearing double tax withholding.
All right, thanks very much for that. We'll keep going. As I say, there's still some questions on that, but I think we need to keep moving for this morning. Shall I move forward to slide?
Yes,
okay.
Please. Okay, so going to just have a quick run through repatriation. So if we move on to the next slide, yes, so we're looking at practical considerations for the employee and considerations for the employer, so the level of assistance that may be provided. Next slide, please. So the main practical issue that we've typically see for the employee leaving China is that due to the foreign exchange control in China, there is a quota on the amount of income that can be taken out of the country. As Adrian's already touched on this around the equity reward position. So there's an annual quota of 50,000 US dollars. If the accumulated remittance amount exceeds the $50,000, then supporting documents are required by the employee, and they need to be submitted to their bank. For example, the employment contract or assignment letter, or the individual's income tax certificates confirming that tax has been paid, etc. So what we generally find is that most assignees can actually arrange this on their own with the help of the bank, but again, local practice varies from location to location. So moving on.
The other aspect we want to just bring up is when an employee returns to the UK, usually with our clients, they're provided with relocation expenses or relocation assistance, and a lot of times companies don't quite have the right systems in place to monitor how much is being spent on this and how these should be reported on the UK side. So just a quick recap that if you've got individuals that you're bringing back to the UK and you provide them with qualifying relocation expenses which are really directly relating to the move back to the UK, so like flying back, shipping of goods and things like that, then as long as they fall under the £8,000 limit, then they're all not subject to UK tax. Where they exceed that £8,000 limit, then there may be an obligation to report those on the P11D as an expense, and also subject to UK tax for the employee as well. The other point we want to raise is if the individual is on an NT code and they're returning, then you need to inform HMRC that they're returned so that another pay-as-you-earn coding notice is issued, so they get a normal pay-as-you-earn code notice, and UK taxes start being withheld again from their return to the UK. So we're quite close to the finish of our presentation, which gives us only 4 minutes left. But the last area that we want talk about over the next couple of slides was other considerations that you might want to review when sending people to China and bringing them back. So on the next slide there are 4 main topics to do with, next slide, to do with global mobility policies, immigration, remuneration and employment laws. So taking the very first one, what we find with a lot of our clients, where they've only got a handful of individuals being seconded abroad, or where the employer just doesn't know who's been seconded where and on what terms, it's usually more beneficial to have a standard policy in place. And the pros of this is that you can ensure that there's consistency across people going to China or going into that region, or even going around globally. The employees who are looking for assignments aren't negotiating their own terms. So one may negotiate that he gets housing, another may negotiate that he doesn't get housing but gets schooling, and if you can keep things as consistent as possible, then what we find is it's less confusing on payroll and also from a tax position and who bears what taxes. So the pros of having a global mobility policy is really you can have that consistency, it's easier to administrate, you can make sure that it's aligned with your wider company strategy. So if you've got someone who's key to your business and you're sending them over to China, then they may be on a slightly different policy to someone who just wants to go and live in China, and you're just being a good employer to supporting that move. It also may go through other aspects, as Ruth mentioned earlier. You may want to consider an assignment over there, or you may actually want to consider locally hiring them in China, depending on the situation and depending on the corporate structure that you have in place. And then finally, as you might have noticed, a lot of this presentation is surrounding about tax. So we would always recommend that a degree of tax is included in your global mobility policies, just so it's very clear who is picking up the tax and what elements of compensation. So whether they are only paying tax as if they stayed in the UK, or whether they're paying tax on everything, or whether the employer is paying tax on certain elements of their compensation.
And the last few points that we have on this slide, immigration issues and work visas. Obviously we haven't gone through this at all, but it is an important part of an assignment planning. We have seen assignments before have to be cut short where a work visa hasn't been completed correctly. The assignees had to come back to the UK, and in some of the examples we've seen, that does then have roll-on effects for the UK and the overseas tax position. For example, if an individual is expecting to be not resident from the date they've left to go out on assignment, then a few months later have to come back to the UK because the visa or the immigration hasn't been correctly completed, then that means they're likely to remain UK tax resident, and that will have a knock-on effect to the overseas tax and the overall cost of the assignment, both to the individual and to the company. Remuneration and benefits review, so that's just looking at what benefits you will be providing to your assignees, both based compared to what a UK employee might have and what you have overseas. Again, typically one we see is medical benefit, so they might be on a UK medical benefit plan, and it's worth considering whether they will then be covered on their overseas assignment or whether you need a further reaching plan. And lastly, and probably most importantly, Chinese employment law. You obviously need to make sure that you are compliant with any of the rules and regulations in the area where you are working. And again, as we have said throughout this assignment, it does mean that rules and regulations tend to be interpreted differently in different areas, so we do encourage advice to be sought for each individual assignment.
Yeah.
Which brings us to the end of the presentation.
Well, thank you very much for that marathon exploration of all the tax.
We appreciate it's a lot of information, but as you probably can see, it's quite important. Just one last example. One of our clients had someone sent over to China. They'd planned it so that there was no permanent establishment risk, but when the Chinese authority reviewed the assignment contracts, they said, if these clauses in, we're going to assess it as if there was a permanent establishment. Worse than that, they're a regulated entity, so the Chinese authority says, because you haven't got registration for regulated activities, we're going to levy penalties in that respect as well, pull you in front of the various ombudsmen over in China. So certainly something to be very, very careful of when working in China.
Indeed. Okay. Well, thank you very much. We've come to the end of the time in this session, so we've come to an hour, and I think we've had quite a sprinkling of questions throughout. There are still a handful that I don't think we'll get to on this live session, but I will be happy to forward through to Ruth and to Adrian afterwards. So all that really remains for me to do is to say thank you both for your expertise and your explanations today. I really appreciate your time. I think we all do here at CBBC. Just before we wrap up, if you do like our webinars, we record them and we put the slides and the recording online. So if you have a colleague that you or a friend who you think really should have seen this session, or you didn't catch it all first time around, post webinar recordings and PPTs can be found. Just go onto our website, What We Do, drop down, and you'll find a part called webinars. You can also find everything on our YouTube page. If you're new to our webinars, you'll find topics on tax, on IP, on finding a distributor, on all sorts of different things, marketing, doing your website in China, all the different practical aspects of improving your business in and with China. So if you have any feedback and suggestions, if there's anything we didn't get to today, if there's any topic that you would like us to cover in the future, please feel free to contact me there directly, david.martin@cbc.org. So thank you very much, and have a great day. Goodbye now.